I think someone this morning made the comment that if rates keep going up, something breaks, and maybe we're seeing that now. The focus, of course, has been whether it's the economy that's going to break, central banks going too far, or will they keep going until things get really messy? Our next speaker is going to talk about that. His session is entitled The Coming Recession. He's also going to talk to us about what that might mean for portfolios. Chris Joye is the Chief Investment Officer of Coolabah Capital. Please welcome Chris to the stage.
Okay, thank you very much for having me. Appreciate the opportunity to engage with everyone. We've got a very long presentation. It looks like it's a couple of hundred slides, but I won't bore you with that. I don't plan on really using too much of the presentation. And indeed, everything that I was going to say, sort of mid last week, life was pretty good. We were sitting on incredibly high yields, spreads were wide. We only own the safest banks in the world. Never heard of anything called Silicon Valley Bank or Silvergate or what's the other one, Signature. And had avoided like the plague, crypto, tech, anything to do with that. And nonetheless, it becomes the center of our universe. So just a little bit of background. I run about $12 billion of fixed income. I have 35 staff, 8 PMs and traders, 13 or 14 analysts spread between Sydney, Melbourne and London. And we're probably the most active traders of Aussie bonds globally. Last year we traded $70 billion of bonds in very illiquid markets, very volatile markets. And today I'm going to talk to you about the macro outlook, some of our big ideas. I'm going to talk about where we were, where we went, and where we're heading. And I'll also talk about this latest exogenous shock. And one of my PMs actually said to me the other day, it feels like every month we wake up and there's some new crazy event that we have to wrap our heads around. 1 minute it's China and Taiwan, then it's Russia and the Ukraine. A pandemic, we had to build COVID forecasting models. It just never stops. And I was really, to be honest, I was really looking forward to some normality and stability. I had this vision in my head of 2023 just being one of those really cruisy years where there's very low volatility. But suffice it to say, these dislocations beget huge opportunity. And we are once again in that frame. Client just wired us literally a few minutes ago, $200 million of cash to go and buy stuff. And that's the kind of context for this conversation. So where were we? In late 2021, I think it's important to understand where we came from. In late 21, in December 21, I wrote in the AFR that basically everything was cactus. We argued the US 10-year government bond yield was at 1%. We argued it was going north of 3.2. It's currently 3.5. It was at 4. And we argued that would happen because the Fed, we thought, would hike beyond 3%. At that time, the Fed was at 0, and bond markets were only pricing in a peak Fed funds rate of 1%. That was going to be the peak in the Fed funds rate. We're now at 4.75. We underclubbed it, and until a few days ago, the Fed was going to 5.5. And because of the huge increase in discount rates, we argued in December 21 that US equities, which is kind of one proxy for the global price of money, would fall 30% plus. S&P fell 26, NASDAQ fell 36. We argued that our own asset class would get destroyed. I really want to emphasize that. We were uber negative on duration because of the huge increase in yields. As it transpired, bonds in FY22 had their worst year in 100 years if you were invested in long duration bonds. And we asserted that investment grade credit spreads would have to widen by about 100 basis points, and that's exactly what happened. So we had $10 billion of credit hedges and credit shorts in our portfolios from June 21 to June 22. Again, it's hard running a long-only fixed income strategies when you're negative on everything. So we were basically in cash. Government bonds were hedged to zero duration, and we had a lot of shorts, credit shorts, and credit hedges. But even that was choppy. Like we saw this is a little bit biased at the time, but the Aussie swaps market blew up, and we had interest rate futures as our hedges, which is what all fund managers use. But the futures weren't actually a very good interest rate risk hedge. We should have ideally had interest rate swap hedges that would have protected our portfolios a little better. But nonetheless, you fast forward to June 22, everything's cheap. So spreads are 100 wider. Duration is suddenly attractive because 10-year yields are at 4%. And so we basically switched our portfolio. We sold about $4 billion of government bonds, and we bought about $4 billion of credit, particularly bank senior credit, bank tier 2 credit. We were negative on hybrids, and we sold about $2 billion of ASX hybrids. Often we're the largest traders on the ASX hybrid market, running beta shares as HBRD capital structure active ETF product, and we went out of hybrids into tier 2 and senior. And our key hypothesis, so this brings us to the present and what we expect. Our hypothesis has really been this, that central banks will lift rates to levels that would be higher than markets expected, 1. 2, they wouldn't cut rates as aggressively as markets were pricing, partly because we feel there's a reasonable probability that inflation will not linearly normalise back to their 2% legislated targets, or 2.5% here in Australia. And the risk is, in our view, that you get core inflation rates actually settling around 3%, 4%, or 5%. The truth is nobody knows exactly where, but core inflation rates settling at levels that are uncomfortably high for the central banks. And the risk is actually these terminal cash rates that were priced for the RBA, the Fed, ECB, and everybody else, is that it could actually just be the end of the first hiking cycle. So we could have, I guess, a couple of contingencies. We could see central banks, they're all priced to pause in the next few months. So everyone in the world is going to pause soon. And we could have central banks pause for an elongated period of time to try and combat sticky and stubborn belligerent inflation. And we'll get new CPI data from the US this week, but one of the fears we had was the recent data that we've seen come out of Europe and the US. So core inflation was re-accelerating. And I've got to shout out to my chief macro strategist, Kieran Davies. KD was head of forecasting at the Commonwealth Treasury, and he's called this economic cycle better than anyone else on the planet. He's been unbelievably hawkish since kind of late 21. And said the Fed's going to 5 to 6 and the RBA is going to 4 to 5. I thought he was crazy. We were hawkish, but we weren't as hawkish as KD, but he's done a really good job. And one of the things he did was he built and some of this stuff is in the presentation that you can get a copy of, but we build inflation forecasting and decomposition models where we break down the inflation we're seeing, and it was very demand driven, and that was a key kind of insight of his. It wasn't just supply side influence, it was very demand driven in Australia and in the US. So thinking more about the future, basically our hypothesis is an extended period of higher than expected rate hikes, that then would sit there for a period of time, and we wouldn't see the interest rate relief that's being priced in markets. And in fact, if inflation does stay sticky at 3 to 4 to 5%, what we could find is that there's a second hiking cycle. And this is not priced at all, and this would be disastrous for risk. We think equities are pricing in the change in discount rates that we've seen. We do not think that equities are pricing in a recession. We do a lot of modelling on the probabilities of recession. The bottom right-hand chart on this slide is hard to see, but I can explain it to you. And the blue line is our US recession forecasting probability back to 1950. The grey bars are US recessions. And when the number on this blue line has been above 30, the model's never been wrong. Currently it's 70. So what that means is the model's saying there's a high probability of a US recession in late 23, 24. And we've been saying this since January 2022. In January 22, we said that the power put option's dead. They don't give a rat's ass about bailing out equities, and that they're just going to keep on hiking. Powell himself has been quoting Ronald Reagan. I see some older faces in the crowd who, like me, were born perhaps before the 1980s. And Ronald Reagan used to say, we need to stay the course through Volcker's rate hikes. We need to stay the course to crush inflation, to have a recession we had to have, much like Paul Keating did in 91. And Powell has been running around quoting this stay the course tagline, which other members of the Fed are also using. So their view is they'd rather overhike than underhike, and they'd rather err on the side of engineering a recession and crush inflation rather than not hiking far enough and dealing with entrenched inflation pressures. So we don't think risk markets are pricing in an earnings recession. We think that risk markets have finally belatedly got the story on discount rates. That's why in December 21 we said equities would fall by 30% based on the discount rate forecast, up to 60% if we got a protracted recession. Cyclically adjusted PEs still look very expensive. I have a chart here on cyclically adjusted PEs. It's the the top right-hand side chart for the S&P 500, and so it's the mean and median is around 15 to 17 times. I can't even see that number, but I'm assuming it's about 29 times. Somebody could perhaps 30. There you go. Very nice. Very good eyesight as well. So equities still look rich in our view. We also think that a key component of this cycle is that it'll look very, very different to all the cycles that we've become conditioned to expect for a few reasons. The first reason is, in contrast to past cycles where we've had these big shocks, interest rates have been floored down to zero, and we've had money printing endlessly, so QE to infinity. And that was a policy reaction function. That was a response that the central banks could bequeath when there was low inflation or disinflation. There wasn't an inflation problem. I actually set Coolabah Capital up in 2011 to offer zero duration floating rate strategies that would outperform in a rising interest rate climate, because I felt that the QE to infinity and zero interest rate policy reflex of central banks would eventually end in an inflation crisis, and that inflation crisis would not be able to be combated with those conventional tools, and we'd have to see very high cash rates once again. So this is key because it means that there's no necessary robust rebound in asset prices. I have a friend of mine who inherited $100 million from his very lucky father, property developer father. And he said, "Chris, what am I going to do with the cash?" And I kind of gave him a few opinions, but he said, "I'm just going to put it in cash, earn 4%, commercial property is going to fall 25%, and I'll buy that commercial property and make about 30%. I'm like, "But dude, commercial property is falling 25% because interest rates have gone from 0 to 4%, and you need to pay a 4 to 5% risk premium above cash, and the 10-year government bond yield's also at 4%. So those commercial property yields that, A-grade office property at 4.5%, that kind of needs to go to 8, or some number, thereabouts. So this is a permanent change in asset prices. I think that's a key insight. This is a regime change where you've got a permanently higher cost of capital. Even if the RBA does cut, they think the neutral cash rate is 2.5 to 3.5. We're only at 3.6 right now. They're not in crazy restricted territory. The RBA doesn't think that. We had lunch with Michelle Bullock, the Deputy Governor, a week or two ago, and she actually made the point that, listen, we could lift our cash rate a lot higher and crush inflation, but unemployment would go to 7%. And we are trying to thread the needle and trying to preserve some of the employment gains and retain some decent wage growth, because the RBA is more fixated on their dual mandate, which is full employment and price stability or low inflation. So one of the big ideas I want to ventilate today was the recovery is likely to be very modest, and asset prices are likely to track income and wages, and we're not likely to see the huge asset price inflation that we've seen in previous cycles where rates went to zero and we had endless QE. The next idea that I wanted to discuss was the fact that we feel that there's likely to be a very large default cycle. Now, we've been talking about this for about 12 months, and I don't know if the guys actually have the right charts here. Gaza, help me. No, we don't. So that's all right. But the long and the short of it is that we need to understand that the world after 2008 changed fundamentally, because the likes of PIMCO told us that the new normal, remember the term the new normal, that was the low rates for long paradigm. Even our friend, esteemed comrade Phil Lowe sort of advanced this idea that rates would not rise above zero until 2024. Fortunately, we're in 2023 and the RBA cash rate's 3.6%. But entire industries and business models and asset classes were predicating their existence on the assumption of this low rates for long meme or paradigm. And that was evident in the explosion in the high yield bond market, the explosion in private credit, which really didn't exist before the GFC, if you think about it, right? Before the GFC, banks provided most of the credit to businesses. In 2008, the regulators rocked up and said, "Hey dudes, you guys have been lending to lots of folks who shouldn't be borrowing." That was the learning of the GFC. And we want to restrict your lending to resi developers, commercial property owners. And what you can see on the screen here, these zombie companies. We track zombie companies live in our systems, albeit we can only now currently access FY21 data. But if we look at the share, a zombie company is a company that doesn't have enough profits to service the interest on its debt. Doesn't have enough profits to service the interest on its debt. And if we look at the proportion of zombie companies on listed exchanges, this has been prepared by my colleague Tully, Thanks, T-Rob. If we look at the share of listed companies on exchanges that qualify as zombies, they have increased over the last decade, and we should introduce these charts, guys, if we can grab them at some point. They've increased in the last decade from about 5% of all firms to about 10 to 15% of all firms. So there's been an explosion in zombie companies. Now, what's worrying is this is based on FY21 data, right, before the rate hikes. So if we were to extrapolate out to the current period where we've had these huge interest rate hikes, clearly these zombies would have proliferated or propagated to a much greater degree, and there will be many, many more affected firms. So the issue, of course, is the people providing this finance to these zombie firms, the private credit guys and the high yield bond market. A lot of these folks weren't even either alive in the last default cycle, which was 1991 here in Australia, and they certainly weren't running businesses in the last default cycle. And so when we interrogate the private loan market, the RMBS market, the ABS market, what we find is that there is a massive gaping chasm, and we are very expert on this, a massive gaping chasm in the quality of lending standards between a big bank, one of the four majors or Macquarie, and the quality of risk assessment and lending standards that we see in non-bank lenders. Non-bank lenders are very, very keen to grow assets under management, and they just want to get loans out the door in high volume so they can grow their fee base. And I think, there are rumours that Australia's biggest subprime home loan lender, I won't name them, is currently on the chopping blocks to be sold. And I think you'll see a lot of consolidation in that industry. I think a lot of these non-bank lenders won't exist in a few years' time. Once we go through a default cycle and we learn the lessons around the true cost of illiquidity. One of the things that has been advocated over the last couple of decades, or certainly post the GFC, is the value of illiquidity, which is kind of slightly counterintuitive. Normally, liquidity is a good thing. But the super funds and folks in the private loan space have really argued that, hey, you don't have to have any liquidity, but the benefit of that is you don't have any volatility, right? And therefore, your NAV just kind of seamlessly advances in a linear line. We never have defaults because we always extend and pretend. And this illiquidity risk, which is concealing tremendous hazards, is likely to come to fore in what could be the mother of all default cycles. If you think I'm being hyperbolic about the mother of all default cycles, the RBA ran analysis late last year, and they said, which is rather germane and salient, again, Tully was instrumental in this analysis, rather germane and salient, they said that, why don't we ask the question, this is when the cash rate was probably around 2%, what would Australia look like if the cash rate was 3.6%? And what they found was that at a 3.6% cash rate, 15% of all Australian borrowers would have negative cash flows, right? And they measured this basically taking their incomes and deducting from their incomes their mortgage repayments and only essential living expenses, right? So this is not even considering discretionary spend. So 15% of all Australians will have negative cash flows, which in theory means they may not be able to service their debts. So you can imagine what that means for default risk. So that's something we're pretty concerned about. I might just switch now to talk about Silicon Valley Bank and the current ructions in markets. And there's a lot of dissonance between the asset pricing that we're observing today. Actually, before I do, I did want to just address one point that's existential to asset allocation, which is this chart. So it really casts into sharp relief the problems with the liquidity and the problems faced by asset pricing really across different sectors. I wanted to kind of throw into sharp relief this chart. So this chart shows you the interest rates we can currently get on cash, on government bonds. So on cash, you're getting 3.6%. Government bonds, you're getting 4 to 5%. On senior bank bonds, you're getting kind of around 5%. And on tier 2 bank bonds, you're getting 6 to 7%. In fact, we bought $210 million last Monday of a bank tier 2 issue, CBA issue. So CBA issued this bond paying 6.7%. This bond's BBB plus rated. It's got daily liquidity. I can trade $100 million a day. I don't think it has much default risk. If you think CBA is going to default on its debts, then you may not want to assume an exposure, but most people would be pretty comfortable with the idea that CBA has incredibly low default probabilities. So it basically has limited to no default risk. It's liquid. It's debt. It has a hard maturity. It's not a hybrid. It's not a perpetual. It ranks ahead of hybrids in the capital stack, and yet it's actually paying a bigger spread than a CBA hybrid on the ASX, which was also interesting. So our clients, we run money for, this is public information, but the likes of Uni Super et al., and they're saying to us, if I can get 6 to 7% on bank bonds, well, I need 3 to 4% above that to consider anything else, because I'm talking about CBA bonds that are liquid, that have no default risk. So what's my risk premium above that new hurdle rate? It used to be kind of, that same bond, by the way, in 2021 would have paid you a grand total of about 1 to 2%, right? But now I can get 6 to 7%. To consider anything else, you've really got to be 8, 9, 10%. And that's a trade that they're prosecuting with great vigour. And what I've juxtaposed here is the red bars, which is A-grade office property at 4.5%. I remember bumping into a family office in Melbourne only a couple of weeks ago, and they said to me, oh, we're thinking about allocating some more capital to some commercial property at 3.5% yield. And I was like, I don't understand. Like, you can get a TD for 4.5%. How on earth can you rationalise 3.5% yields on property? So we think that's an existential problem for commercial property. And the issue, of course, is it's not trading. Anyone who understands the commercial property market understands that it's highly liquid. It's not trading. These yields are mispriced. I had a billionaire client of ours who owns billions of commercial property say, if I could sell every single asset I own right now and put it into bank bonds at 6 to 7%, I would do that trade. And then we have equities. You've got equities trading on 6% fully franked dividend yields, be it CBA equities or the All Ordinaries Index. So we do think that is a real challenge for portfolio construction. And we are seeing asset allocators respond. So one thing I've noticed in the last few months is these huge book builds for high-grade bonds, where we're seeing investors that have never been in the space before, Asian life insurers and insurers from the US, UK, Europe, and also big defined benefit pension funds that are now running funding surpluses, not funding gaps, because of the increase in interest rates, and they're keen to lock in those funding surpluses through buying fixed rate duration. So that's interesting. So I do think you are going to see, another idea for you to cogitate on is, I think you're going to see an inexorable shift, albeit perhaps glacial, an inexorable shift in asset allocation away from some of these illiquid asset classes, private equity, venture capital, infrastructure, commercial property, resi property, and equities back into fixed income. For the last 30 years, the secular dynamic that has asserted itself has been lower interest rates and a shift out of bonds and cash into those search for yield solutions that I just referred to. And we think that dynamic will start to reverse itself out. And that's what we're seeing. Just conscious of time, so I just want to conclude with some comments on Silicon Valley Bank, and happy to take any questions. Long story short, on average, 25 banks a year die every year in the US. So that's since 2001. Since 2012, 7 banks a year have died every year in the US. And the US has over 4,500 banks. Pre-GFC, it had over 8,000 banks. Very different to our system, but they have these local area banks that tend to be very geographically concentrated and often very industry dependent. And Silicon Valley Bank was a classic case of that. Basically, 100% of its deposits came from the tech industry, and 91% of its loans went to the tech industry. And that created tremendous cyclical vulnerabilities. So when the Fed jacked rates up from 0% to 4.5% to 5%, they've obviously crushed fintech, crypto, startups, and anything related to growth. And so the venture capital funds started pulling money from Silicon Valley Bank, SIVB, and they lost about $30 billion of deposits between January 22 and March this year. And they originally had, I think, about a $185 billion deposit base. And to service those deposit outflows, because venture capital funds needed the money, and their startups were burning through their cash, to service those deposit flows, they had to sell assets. So problem number one was their cyclical dependency on one industry. So that created this credit event for them where they had a run on deposits. Problem number two was their asset base, very unusual. In December 2022, they had 173 billion of deposits, and they actually only lent out 74 billion of those deposits via loans. Normally a bank would lend out more than 100% of its deposits. And they put the rest of the money in RMBS, residential mortgage-backed securities, in CMBS, commercial mortgage-backed securities or commercial property loans, and into US Treasuries. Aussie banks hedge all that risk back to floating. So they'll invest in fixed rate bonds, but they take that interest rate risk profile back to floating. Silicon Valley did no hedging. And so SIVB therefore suffered massive losses on its bond portfolio. These bonds were held on a hold to maturity basis, which is normal for a bank. But what is unusual for a bank is they weren't recognizing the reduction in the value of the assets through their capital ratios. Big banks in the US and banks in Australia have to recognize those losses through their capital ratios. Silicon Valley Bank did not. So when they sold $21 billion of bonds in March, they suffered a $1.8 billion loss on those bonds, and they said to the market, hey, we've lost this money. We need to raise $2.25 billion of equity. The market said, no, thank you. And depositors freaked out thinking, okay, there are losses on all their bonds, which there were, because they didn't have the interest rate hedges in place, which is just a failure of risk management. And also almost certainly a failure of lax US regulation. And so they've failed. The response to the crisis has been incredible. So normally the regulators, they bring out pea shooters, the policymakers, and they respond piecemeal, and eventually they roll out these big bazookas. The Fed, the Treasury, and the FDIC went straight for the big bazooka. It was unbelievable. Nobody expected them to do what they did. I expected depositors to recover 100 cents in the dollar. My sister lives in Menlo Park and she had exposures via 2 VC funds, but I didn't expect the Fed to come out and say, which is what they did, we're guaranteeing all US bank deposits, irrespective of size. You cannot lose money on these assets ever, one. Two, the Fed's going to provide unlimited loans to all US banks at a cost of cash plus 0.1%. So US banks had their biggest funding source government guaranteed instantaneously. It will be very hard to ever have another US deposit run. Right? The main way banks fail is through deposit runs because that's their flightiest money. And so they've basically eliminated the risk of future deposit runs. You know, we may see some institutions topple over in the next week, some smaller regional banks, but in the long term, you'll never see deposit runs in the US. One. Two, they have incredibly cheap money that they can then put to work and make very high margins on, so the Fed's backstopping their profitability. And three, the availability of unlimited deposit guarantees also means there's almost no default risk on their bonds. So this net is very positive for US deposits, very positive for US bank bonds, obviously positive for the regional banks and the big, the 8 large so-called globally systematically important banks or GSIBs, and probably negative for bank equity. A few little key takeaways. Every policymaker, every country in the world is probably going to have to emulate what the Fed has done now they've set that standard. It's a very important precedent. Here in Australia, we had an unlimited deposit guarantee in the GFC, but it was rolled back to 250K. I mean, if ever anything happened in Australia, which is very, very unlikely, we would have the same solution. That's one point. The second point is we're likely to see a massive increase in regulation in the US on their banks. So they'll have to hold much more capital, much more liquidity, and that's likely to crimp returns on equity. So this is bad for shareholders of banks in the US. It's good for bondholders of banks in the US, and it's good, clearly very good for depositors. Globally, it's very much a validation of what the APRA has done with the Aussie banks. The Aussie banks have the highest capital and liquidity metrics, the highest quality capital and liquidity metrics of any peers globally. So they're incredibly well capitalised, and they only hold the best quality liquid assets. I can talk more about that. It gets slightly technical, but there's definitely we're seeing a big flight to quality. So we're seeing people looking to buy Aussie banks and looking to buy the biggest US banks. But in the meantime, credit spreads have moved aggressively. So we've seen credit spreads on high-grade banks, so Aussie major bank senior paper or Tier 2 paper, move 20 to 40 basis points wider, depending on the region, US dollars, euros, or Aussie dollars. Here in Australia, they've moved about 25 wider. In Europe, they've moved about 50 or so wider. So funding costs are going up for the banks, but this is providing us with an opportunity to put capital to work in newly attractive assets that have blown out in spread terms, and assets that are very likely to mean revert. Every single time we've seen this happen, there's been strong mean reversion. In 2011-12 in Grexit 1, in the taper tantrum in June 2013, in Grexit 2 in 2015, the near collapse of Deutsche in February 16, in Brexit, in the discount rate drama when the Fed first lifted rates to over 2% in 2018, in the March 2020 pandemic shock, and now again in 2022 when spreads blew out and they've come back in much tighter and now they're blowing out again. So temporary hit via spreads, but bank bonds have now become even more attractive which will also create a high hurdle for all other asset classes. So this was likely to flow through to other asset classes. Final comment would be, interestingly, equities is kind of ignoring this stuff. So US equities, for the time being, have sort of shrugged off the news. And yes, regional banks are getting destroyed, but overall, the US equity market was broadly unchanged yesterday, up in the overnight session. So US equity futures, last time I looked a few moments ago, are up. And then the bond market so duration has gone through the mother of all rallies. There's been a huge reduction in long-term interest rates, and that's being driven by people paring back where they think the Fed will hike to, where the RBA will hike to, etc. It's likely a function of the fact that the quantum of shorts in US Treasuries was at all-time record highs. So the whole world was shorting US Treasuries, betting on interest rates going up and betting on this uber hawkish Fed. And then this Silicon Valley issue comes out of nowhere. Everyone freaks out. Everyone thinks, okay, the Fed doesn't need to hike as far. So and all the shorts are now having to cover. And the way they cover is they buy bonds. So there's this massive bid for bonds. So the duration rally that we've seen in the last few days has probably gone a little too far, perhaps. We'll have to wait and see. Yeah, so that's probably my summary of that price action. Happy to take any questions. I realise it's late in the day. I understand there probably won't be any questions.
Just a really quick one. What does that deposit guarantee say about the risk assessment of the individual banks themselves? So vis-a-vis well-run banks, badly run banks. I mean, where does it go? What's the unintended consequence of that?
Yeah, it's funny you should say that, because I was saying to one of my colleagues only a few moments ago, the funny thing is, now the Fed's guaranteeing all the deposits of all these small regional banks, they can charge whatever interest rates they want on those deposits to compete for flows. Obviously money is shifting compositionally in the United States out of the smaller banks into the bigger banks. So the smaller banks are going to respond with higher interest rates, but they've got to earn a positive net interest margin. So what do? They're just going to go out and do what the private credit guys do here in Australia. They're going to chase risky credits, and unless they regulate very aggressively what they can and can't lend to, which they do through risk weights and so on and so forth. But the point you've made is incredibly insightful. This is all about moral hazard and the consequences of moral hazard. And the only way to mitigate moral hazard is what comes hand in hand with a massive taxpayer guarantee of the US banking system is massively intrusive regulation. Now, whether that will survive the US political process, open question. But the only way to mitigate that moral hazard is by really putting tough constraints on these banks. That's my answer. Paul?
So the flip side to that, I was almost identical question. The flip side to that is, do we have a massive outflow from JP Morgan, Chase, etc., all the large banks? Because the reason why the money flowed there was for safety and whatnot. You were getting a lower rate, but you went there for safety. So now I can go and go with a regional bank, get a higher rate, and I don't have risk. So I'd do that every day of the week, wouldn't I? And does that create problems for large banks in terms of outflow?
Yeah,
and
this is the problem when you interfere with a freely functioning market. You create all these first, second, third order consequences, and that probably, some of the smarter, smaller banks will suddenly offer incredible rates, and then they will attract capital from the larger system. Because the benefit of being, they're called a GSIB, a systematically important bank, in the United States has just disappeared. Because actually, you best go to the riskiest bank you can find, get the highest possible interest rate on your deposit, and bugger the consequences. They can do whatever they want with the money because the Fed's guaranteeing that on Monday you get 100 cents in the dollar. Any other questions, guys?
I want to come back to your quote, which sort of slipped by almost unnoticed, which is the mother of all default cycles, which caused me some concern. How do you see that actually playing out?
Yeah, I might be wrong. It may not be the mother of all default cycles, but what we're expecting is a big default cycle. And we're already seeing in the US, you've had 3 banks go under. They've all defaulted on their bonds. And I think it's going to take time. I think you're going to see a lot of extending and pretending from banks and non-banks. So they're going to be very, very keen to conceal their defaults from all of you, right? I've heard these non-bank lenders say, I've never had a default. In March 2020, one of the biggest non-bank lenders in Australia said, we have no loans in default, but yet 40% of CBA's business loans were in default. So how could that possibly be the case? Because Well, the answer to that question is, when anyone rings up and says, I can't pay my interest, they say, oh, no, that's fine. We'll just restructure the loan. You don't have to pay any interest anymore. We might take the equity in your business and become an equity investor, but so I think it's going to be iterative. I think it's going to be 2 steps forward, back, 1 step back in terms of the data and the flows, insofar as we are seeing a lot of cross currents in the data. 1 week we'll get some positive, labour market data. The next week we'll get very bad confidence and business conditions data. And we know that there are these very long and variable lags with monetary policy. This cycle is being thwarted in Australia by the advent and proliferation of an unprecedented amount of fixed rate debt. So in the pandemic, the RBA rocked up to the banks and lent them $188 billion through the 3-year term funding facility. That was fixed 3-year money that they lent to the banks at a cost of 0.1% per annum or 0.25% per annum. That's why we got cheap 3-year fixed rate home loans at 2%, or 4-year loans or 2-year loans. And about 45% of all Aussie home loans became fixed rate. In the past, only about 15% have been fixed rate. So normally the RBA's transmission mechanism would be much faster and more potent, but because those fixed rate loans came into being, that dulled the immediate transmission of policy. Most of those fixed rate loans are rolling over in the next 12 months. And as they move from 2% interest rates to 6% interest rates, we're going to see the economic consequences. But I think you'll just see lower economic growth, reduced consumer spending. You'll see poorer GDP data, weaker wages growth. You're going to see the unemployment rate increase sharply. And you're going to see many, many businesses going bust. And lots and lots and lots of layoffs. And I'm seeing in financial services, there's been a profound change in the zeitgeist. Last year we have lots of software engineers in-house. Last year I wouldn't get one decent application for a software engineer or a trader. We put out an ad for a trader in London a couple of weeks ago, and I think we've had 300 applications and probably 50 really, really good candidates. There was definitely a sense amongst the 20 to 30 somethings that have only worked for a period of falling unemployment rates and endless employment opportunities with fintech, crypto, startups, growth, and investment banks paying, and other organisations, management consultants paying incredible salaries. There was a sense of entitlement, and that has been eviscerated recently, and we're finding tremendous opportunities with talent. So I think the labour market is souring. We've also got this record migration, which is flooding Australia with a lot of labour, which is great, which will alleviate the wage pressures that the RBA has been concerned about.
Yeah, but not the rent pressure.
Correct.
Right. Other questions? Yep.
I think we've also got one here. Just this gentleman here. Oh, no?
Thanks, Chris. That was a really good presentation. Quick question for you on how you've think the interplay between a lot of what the government's trying to do versus the central banks. We've obviously seen, Phil Lowe and obviously Powell in the US face these parliamentary inquiries around what's going on, and obviously they're getting pressure from their local members of parliament because they're hearing about what's going on with mortgage payments increasing. But do you think the central banks are just going to kind of ignore that pressure and just keep going, kind of like rip that band-aid off? Or do you think the interplay between the government having all these inquiries are actually going to make them potentially change their rhetoric as well?
Yeah, so this is a really important question. It talks to the politicisation of the central bank. So I had thought the central banks were being politicised over the last couple of decades, and certainly when Trump was in power, he was heavily politicising the Fed. And one of our hypotheses in late 21 was the reason we thought the Fed would only go to 3% is we thought that the politicians would throw sand in the wheels of the hikes and try and prevent the hikes. What we didn't anticipate was that the inflation crisis would become a cost of living crisis, and then that would then give the central banks the imprimatur of the politicians who wanted to blame somebody for the inflation and cost of living crisis, and they shifted the crosshairs to the central bankers, and then the central bankers got this green light to become as hawkish as possible. I do think the Fed, the RBNZ, the Bank of Canada, the Bank of England, and the ECB are all pretty hawkish and fairly resistant to moral suasion from the politicians. Having said that, I think that the RBA is a different case. I mean, you've got this poor guy, brilliant guy, MIT PhD. He was a superstar his entire career. He was bred and built to be governor of the RBA, and it was meant to be a seamless ride like Glenn Stevens and Ian Macfarlane and Bernie Fraser before him experienced. And sadly, it was not meant to be. And one of the lessons of this experience, I think, is, training as an academic economist and then working as a practical economist is not necessarily the best training to be a great decision maker under situations where you've got a lot of stress and duress, and you've also got imperfect information. You might be a great researcher, you might be able to write good research reports and give decent speeches, but can you make complex decisions under uncertainty repeatedly with high efficacy? So that's just that observation. I think the RBA, he is having a total crisis itself. They've lost all intellectual confidence. Their approach from May 2022 to today has generally been to ape whatever the Fed's doing. But they also realise that the Aussie economy is very, very interest rate elastic. And I think that they're worried that they talk for years about getting full employment and for years about restoring wages growth back to 3 to 4% per annum. For basically a couple of decades, we've had sub 3% wage growth. They think a key policy imperative for the RBA is to deliver full employment that will then deliver 3 to 4% wage growth. They think 3 to 4% wage growth gives you sustainable inflation within their target 2 to 3% band. So they made that intellectual case relentlessly. So they got the unemployment rate down to 3 point something. And I actually argued this in 2021. I said, if you hike rates too fast, you're going to snuff out the wage recovery that you've been working for so long to engineer. And that's kind of what's happened. The recent wage data was quite weak. The labour unit cost data printed at 2.8%. The wage price index only printed at 3.3%. People were thinking that they'd have bigger numbers. And suddenly the RBA, when it's been faced with this batch of weak data, this was in like February/March, they kind of had this metamorphosis where they went from being uber hawks to suddenly super dovish because they're worried that they've destroyed the kind of, the intellectual case for the stimulatory policy that they had in place for so long. So I do think that your intuition and your insights are sort of bang on in the sense that I think Phil Lowe is being politicised by his own intellectual insecurities in a way, or he's being influenced by those failings. And there is an independent review of the RBA. The review of the RBA, it's the first review that there's ever been, in as long as anyone can remember. And that review will definitely, one way or another, lead to his departure. It will lead to the appointment of an external, a lateral hire for governor of the RBA, probably the female former Bank of Canada member. And the RBA, I used to work at the RBA. I mean, the RBA is the most dysfunctional organisation I've ever seen in my life. No, it's just horrible. It's like purely hierarchical, tenure-based. There's not much internal debate and dissent, massively political. I went from Goldman Sachs where in my first year I pulled 90 all-nighters. So I worked for 2 days consecutively without sleep. I was working in mergers and acquisitions and principal investments in London. Malcolm Turnbull hired me out of university when he was chairman of Goldman's and for my sins. And I went for 3 3/4 days without sleep one day. And then I decided I want to work for government before going off to study at Cambridge University. And I thought, my dream, I'd always loved economics, was to work at the RBA. And I rocked up and basically everyone floods into the building at exactly 9 a.m. and everyone floods out at exactly 5 p.m. And my body couldn't handle it. I was like, my day's just starting at 5 p.m. I'm used to working till 1, 2, 3 a.m. and it was just such a culture shock. I'm not suggesting, by the way, that's a good work-life balance. Other than for my own staff, I've got members of my team in my room, and they know that if you want work-life balance, our place is probably not your first port of call. But yeah, does that answer the question? Yeah, that's good. Sweet.
Given what you've told us already, what you've told us in 30 minutes, we would have probably taken a whole day to understand. And given that you said about the RBA and Governor Lowe and the immigration being high and the wages low and a lot of problems coming our way, can I take it that the answer to the question about what you were talking about, the coming recession, is yes?
Listen, we have high conviction that there will be a global recession and a US a recession. I don't think we have as much conviction in an Aussie recession. That's not to say that, I'm not saying that there will or won't be one, but what we do know is that there's going to be a massive destruction of demand in this economy. So the RBA is destroying demand. That's its imperative. We know the unemployment rate is going to increase sharply. We know that wage growth is likely to lose a lot of momentum, and it's going to be very, very difficult. And it could be very difficult for a long period of time. I mean, the markets are thinking the RBA will be cutting later this year. When somebody put that to Deputy Governor Michelle Bullock at our lunch with her the other day, she laughed at the proposition of cutting this year. She said, "Look, cuts. Are you kidding?" Like, they're very much in the mindset that this is going to be a multi-year campaign to try and get inflation back to target. They don't get back to target till 2025. So, but I do think it's entirely plausible we could have a recession. We just don't. I don't have right now any unique quantitative insights to kind of provide an evidentiary basis that would give me conviction that we think there's going to be a recession in Australia. But Australia is the wonder down under, according to The Economist, and it is an unusually agile economy. The population growth is potent for growth in turn. So we are running record migration. We're going to be bumping back up to 2% annual population growth. We do have very elevated commodity prices. The federal budget, notwithstanding the defence spending that I'm very much in favour of, but is basically almost in surplus. Western Australia's budget is in surplus. Queensland's budget's in surplus. So we really, our antipodal position, our leverage to, in the past, China's growth, all that stuff has been amazing. And we have, one of the biggest drivers of productivity in Australia, and you can see this in the faces in this room, is our multicultural heritage, in the sense that 30% of people living in Australia weren't born in Australia, and 1 in 2 have a parent who was born overseas. So I think that vitality is very important to future prosperity. Got one more. No, come on, mate.
Given your outlook, you're saying that they didn't think rates were going to rise. Are they going to be wrong that rates have to cut?
Yeah, possibly.
Everything you say makes sense, and that means they have to.
Yeah, they may do, particularly if inflation comes down fast. Yeah, okay. Thanks, guys. I appreciate your time.